Welcome to this week's version of Nickels and Dimes, our weekly video series. Well, the equity markets are in a bit of a correction mode, and that's totally normal. We've been on a pretty strong run the last year and a half, 2 years. So having a correction with the market, for example, the S&P is down 5%, the NASDAQ is down, say, 10%, is healthy and normal in the big picture. So this is what we're going through right now. But you might be wondering, how bad could your portfolio respond, and if the markets get worse? So today we're going to talk a little bit about how to stress test your portfolio. In other words, how to potentially better understand the downturn in terms of how much you might be down or lose if the markets get worse. So let's jump in and explore how to stress test your portfolio. And as you know, one of the main rules of investing has been given by this gentleman, Warren Buffett, who's the chairman and CEO of Berkshire Hathaway, who has a net worth of only $135 billion. And he's very famous for many quotes and very wise words on investing. But one of the main quotes most people know Warren Buffett from is this quote: "Rule number one, never lose money. And rule number two, never forget rule number one." And this is a key element to building wealth over time, is when you make money, whether it's from income that you're putting away in a portfolio or from appreciation, you want to be managing risk. In other words, managing your principal so that if the markets go down, you don't give that gain back. So again, preserving wealth is very important. Now, the reality is most people, if you're investing in the market, you're going to be down at some point and you could potentially lose. So this is more of a philosophy and sort of a don't forget this principle, because Warren Buffett, in my opinion, is 100% right here. You need to be focused on risk management and, as I noted, preserving your capital, particularly since we've had a very good equity run the last year and a half or so. Rule number one, don't lose money. And rule number two, don't forget rule number one. Well, how would your portfolio perform in a big market downturn? Here are the last handful of big downturns. So for example, let's just say you had, let's call this portfolio one, which in most cases is not ideal. In other words, you had a portfolio, maybe it was some stocks and bonds. This is actually how a hypothetical portfolio would have performed in certain downturns. So for example, the tech bubble in the early 2000s, right after 9/11, the market was closed for a little bit of time and then it reopened. The World Trade Center attack, market in this portfolio was down 11.24%. The subprime crisis in the 2008 financial crisis, coronavirus in 2020, and even when we had a big downturn in the 2021 top, this is not an ideal portfolio in terms of how much it would lose if these scenarios happen again, hypothetically. Well, what if you had a more ideal portfolio where, for example, we had another tech bubble? This portfolio, let's call it portfolio two, the more ideal portfolio, would only be down 6.35% in the tech bubble. And in the World Trade Center attack, when the market reopened, this portfolio was down only 6.45%. So let's look at one versus the other. Portfolio one, not ideal. You could see portfolio two on the right, more ideal. Which one would you choose in a most ideal scenario? Obviously, most people's situation, they'd likely choose number two, simply because you have lower risk, you have lower downside, and in most cases, it likely will give you some more peace of mind, especially if we enter into another big economic downturn. The reality is, as you're nearing retirement, you want to be reducing your risk to the overall market, reduce your risk to the overall equities, simply because you want to make sure, again, you maximize your principal, maintain your principal. As of course you're in retirement, you want to still have the same philosophy. The two main goals as you're in retirement, number one is preserving principal, and number two is generating income and growth. So again, in most ideal situations, I'll go back to this portfolio, you want to be in a portfolio that in theory would react like portfolio two. Now I want to bring up a gentleman I quoted last week, David Rosenberg from Rosenberg Research. He said, quote, "For the retiring baby boomer community, over 60% of their asset mix is in equities, which is double where it should be at this stage of their life cycle. What is he specifically referring to? As I mentioned a few times, the equity markets have done really well over the last year and a half. We're having a little correction now, which again is normal. Maybe you have a larger percentage of your portfolio in equities than you traditionally should have, at least based on where you are in terms of retiring soon or even in early retirement if you are. But of course, maybe it's too much risk that you're comfortable. Now, most people don't think about risk until the markets start turning south or get even worse. So I want to remind you, as we always talk about, you must have a few things in your financial game plan. Number one, clarity on your goals. Or if you're going to retire, say in 5 years, you need to get a game plan together to make sure you're on track. Or within a year of retirement, for example, you need to make sure you're on track. Number two, your risk tolerance. Get clarity on what you're most comfortable investing in. Get clarity on your risk profile, scale of 1 to 10. 10's aggressive, 1's really conservative. Where are you on that risk scale? And number three, the family index number. This is what we talk about pretty often. What's the rate of return that you need to earn now to get you to retirement? And what's the rate of return when you're in retirement that you need to live your ideal retirement life? So again, is your portfolio ideally balanced to match your risk tolerance to meet your financial goals? Let's do a stress test. For example, this is some of the software we use that I showed you earlier that we could run an analysis to determine if we had another downturn, if we had another financial crisis, if we had another situation where the markets took a big downturn, how would your portfolio respond? To that end, if you like this video, if you found value in this video, go ahead and share it on Facebook or LinkedIn or forward it in an email if you get it in an email. If you would like a second opinion on your portfolio or financial situation, if you would like us to do a stress test of your portfolio, this is our website at nicholswealth.com. Click on the Request an Appointment tab, fill out the information when one of our advisors will reach out to you, answer your questions, and do a stress test analysis to help you get clarity on your portfolio and your financial situation. Thanks again for watching. Bye-bye.